3, 2, 1. Welcome to the show, everybody.
Right. It's Friday again.
Friday again.
Very cool. Well,
first of the month.
If you're watching it, it's Sunday.
Yeah. We
But
try to
Friday
record
for us.
these on Fridays, but so we can actually have a weekend. Well, Jerry
Well,
doesn't.
I don't get a weekend.
Jerry doesn't get a weekend. He's doing the newsletter and everything else. So poor guy. He gets Mondays off.
Monday is the Sunday pretty much. As long as nothing goes crazy on Monday. I just got a text from a buddy of ours that said I can't exactly understand what he's saying, but if the S&P stays above 38, so I guess the C fund must be $38. It hits his number, so he can retire.
Nice.
So congratulations.
Nice.
And I got to get back to him because the question is, okay, so if your number gets hit, so the S&P gets over a certain amount, you're in the S&P. Now I've got my number. Now I can retire. So
what do you do after that?
Yeah, I mean, were you going to immediately go to the G fund?
Yeah.
Right? Because
you better, if you're that concerned about keeping that exact amount,
right,
you better lock it in.
Right. And so that's always the thing. Like when you retire, and he's younger than me, 50-ish, but
gotta love law enforcement.
Yeah, we're gonna actually talk about that. Yeah. But you once you retire, if you're gonna take that money and pay off your house or buy a second house or buy a company or whatever, that's one thing.
Yeah.
But if you're not, if you're gonna like live on your annuity,
right.
your retirement, the pension side, and
maybe go get another gig or something.
Yeah. Then what are you going to do with that TSP money? You invest it the same way is the bottom line.
Oh, 100%. Yeah. I mean, we had someone send in a question for the member call that we didn't get until after we did the member call. Yeah. For those of you that aren't members, we do a one-on-one call, not one-on-one, but one-to-many. Like it's
a
members,
webinar.
It's members only.
Webinar.
Members only, and we do it live so they can ask questions. And she had asked a question before, and I thought it was a great question. Basically, she's really getting the rhythm of this, our philosophy, methodology, and where can I find a place to do this like that? And that's hard to find, honestly. Yeah. But there are people that do it similarly, but you got to find some place. I mean, we're lucky enough to be able to manage our own IRA accounts. But if you don't want to do that, honestly, you can use the same stuff that we do, for the TSP. You can use that in your IRA, actually, a lot better because you have a lot more flexibility and everything.
Right. Yeah, it's very tough to find a fund manager that is managing your account based on technical analysis versus some sort of a buy and hold thing. So if you buy into what we're doing here in TSP, it's tough to find somebody in a retail space that
and there's nothing wrong with it. It's just a different strategy, and most wealth managers or financial advisors, there's a lot of terminology in this industry that most of it doesn't mean exactly what it says. You know what I mean? Yeah. What you'll find is a lot of financial advisors, they don't even really manage the money part. They kind of push that off to a third party. So they'll buy models that they use, and again, this isn't, I'm not saying this is a negative thing.
No, it's how it is.
It is how it is. And so they'll have a model that they attach to you because, you've answered some questions a certain way, and that's the model that you're in. And it's going to be pretty passive. It's not going to move around much. Once a quarter, you'll check in, maybe twice a year, they'll make a move just to rebalance. Yep. I mean, that's kind of how the main part of this world works. Yep. And we're not necessarily big fans of that as a strategy, just because you can. There's a potential for a huge downside. If you go through these times, and we're just not willing to do that.
It's hard because most people in TSP don't really look at it this way because either you're in some version of buy and hold, which is fine, or you're actively managing it, which is fine, or you're in an L fund, right? But for most.
Yeah, which is a passive version of buy. I mean, a more active version of buy and hold.
The L fund it's based on your.
The L fund at least moves around.
Yeah,
it may not move around on for reasons we agree with. But
it moves around because of your age, which what that has to do with anything. I have no idea.
The market doesn't care.
The market doesn't care. No, so it would be nice if there was a fund that moved based on what the market does, which is what we do. But if you're in a like you said, a model, most of that is 60-40. Because you want some level of security in your retirement account, right? The problem is security or risk, right? You could kind of define it the same way. If bonds are going down, if it's not working, that bonds are kind of acting as a buffer when stocks are going down, then they're both going, like in 2022.
Really getting screwed.
What I'm trying to get to is there are a lot of people out there that don't like to admit it, that are underwater still from 2022 by a lot, because bonds never came back.
Right. I mean, everybody's really happy about what the market's doing this year, but they don't want to recognize the fact that they're still not recovered from 22. If you follow the kind of normal, quote unquote normal,
and you're only
advice.
getting, like, let's say you're 60-40, an S&P 500 fund 60% and a bond fund 40%. You've gotten 60% of the gains this year on the C fund side, but and you've gotten 40% of the gains on the bond side, but which it's not. Bonds are still going down. So
that inverse relationship doesn't really work anymore. And this is something that actually Jerry and I talk about quite often, off the air or whatever, when we're just chatting here in the office. But because we're both kind of going through programs, to kind of further our knowledge and things in the financial industry. And one of the things you realize really quickly is the rules have changed, and most people don't want to acknowledge that. I mean, some people will talk about it openly. If you watch the right people and follow the right people, they're kind of transparent, and they'll admit that, like, that whole 60-40 idea. I mean, that's just one example. I don't want to harp on it, but it's a pretty tried and true kind of rule that. Everybody still locks into, even financial advisors that we know. And you're like, okay, but that doesn't work right now. Now, not to say it might not go back to normal, but it definitely isn't in the past few years. And to follow that just blindly, it's not. I don't think it's ethical. For a financial advisor to do it.
I mean, the problem is that it's ethical because it's been so true for so long. It's conventional wisdom, and it's the way you're supposed to do it.
Isn't that crazy?
Right?
It's ethical just because it's what we've always done. Even though it's not really, because it doesn't work anymore. It doesn't work right now. And so those kind of old school rules, are what hurts people, because they're like, well, no, you have to do that. Like, everybody knows you got to do that. Okay, well, you're right. Diversification used to be a lot easier when gold did what it was supposed to do, when commodities does what they're supposed to do, and bonds do what they, all these different asset classes, when they were doing what they've done for decades, that system works. And then now, when they're not going the right way, right, when all of a sudden we're not lowering interest rates and the market's still crushing, and you're going, okay, that's not how it's supposed to work. But it is. And so you just have to, that's why, if you follow this show, what we kind of promote is the fact that the market doesn't care about your personal circumstances. Doesn't mean that your personal circumstances don't matter. Don't take it that way. Right. It just that the market doesn't care, because it doesn't know you, right? It doesn't know anything about you, so it doesn't care. The market's going to do what the market's going to do. So that's kind of rule number one. And rule number two is that you want to be in the market when the trend is up and out of the market when the trend is down. And the only way you can do that is kind of be an active participant. Right? You can't just kind of sit there and let it happen, because what'll happen is there's going to be years, like what if you wanted to retire in 22 and you had a buy and hold mentality where you're like, nope, I'm just going to ride it. Okay, you're just in a depreciating asset. Your bank account, your balance is going down, and you're just watching it.
Worse is if you did retire. Say you retired in 21.
You're not putting anything in.
You're not putting anything in, and you say you're taking out $1,000 a month, let's say, and you're staying in your buy and hold, right? If the C fund dropped, say 20%, it was like 30% at the worst, but say it finished the year 20% down. So if you're planning on taking out $1,000 a month, let's say, from whatever you had in there, and you're taking a 20% hit on your principal, chances are you're going to have to redo the math and figure out, if you continue to withdraw $1,000 a month, am I going to make it?
Can I make it? It all changed. So if you can see, like, we're big proponents of actually continuing to manage your money once you retire. I mean, we're retired from the government, but usually you still end up doing something, unless you're just going to go fishing or whatever, which, we
Some
like
guys
doing.
do.
Yeah, absolutely. We know a couple, and they love it. But they're still actively managing their accounts, because it's just, you can't take your eye off of it and just let it drain.
Yeah.
Anyway, we're kind of
All right.
going on, and let's get on with the
March 3rd,
actual
2024.
show.
We good? So, yeah, we kind of did a little prelude to it, but we're going to talk about an article I pulled up about some of the myths of TSP early withdrawal. And I'm going to take a look at gaps in charts. Gaps kind of spook people, so it's worth taking a look at that. Bonus chart is going to be Apple, and then we're going to look at the monthly candles. So it's beginning of March, and if you look at a chart of the monthly candlesticks, it tells you the direction of the big trend. And to the extent that you want to only manage your account once a month, you can use monthly candles. And then we'll look at the weekly C-Fund chart. So TSP early withdrawal. So pretty interesting article here from FedWeek. They're saying TSP early withdrawal penalty is a myth. So many employees believe there's an early withdrawal penalty for taking anything out of TSP before age 59 and a half, which is not true. The rules for early withdrawal are different in TSP than they are for IRAs. So 59 and a half is true for an IRA. So if you were to retire from TSP, retire from the government, roll your TSP into an IRA, you cannot touch that money until you're 59 and a half, because you've just given up your ability to access it based on the government rules. Now you're in the IRA rules. So that's definitely one downside if you need to use the money, for rolling into an IRA. So with TSP, you're exempt from early withdrawal penalty if you separate from federal service in the year in which you reach 55 or later. So it's not 59 and a half. For IRAs, early withdrawal penalty applies to anything you take out up to age 59 and a half. So if you are a special category employee, what do we call that, 6C? If you're law enforcement, firefighter, air traffic controller, you can't work beyond 60, right? Is that what it was? I think it was 57, 60.
I can't remember
something
now.
like that. I can't remember.
It's been too long for us.
Yeah, there was a maximum. There was an age max, and so because of that, they have to let you, or they let you retire early. So it's 50. It was 25 years at any age you could retire, or 20 years at 50. But yeah, so if you're in one of those categories, you're exempt from early withdrawal penalty if you separate in the year in which you turn 50 or later, unless, like I said, if you do 25 years, you could retire when you're in your late 40s, and you still would not, if you're taking money from TSP, you're not going to get taxed. You're not going to get the penalty on that. You get taxed, but not the penalty. So early withdrawal penalty is 10%, and that's in addition to the taxes that you pay on the withdrawal if you're in a traditional TSP. If you were withdrawing from a Roth, you wouldn't have to pay taxes, but you would have to pay the 10%. So the ability to avoid early withdrawal penalty if you separate in the year in which you turn 50 or 55 only applies to money in your TSP. If you roll over, you are subject to the penalty, like I said. So if you were to roll over your TSP into an IRA after separation before 59 and a half, you would be subject to the early withdrawal penalty, regardless of whether you're a special category employee or not. So one of the things we've talked about, it's been a while, but if you are in the special category, and you retire, and you want to roll from TSP into an IRA, because there's a lot of value in being able to manage your money in an IRA versus leaving it in TSP. But you might want to leave a little bit in TSP so that you can withdraw that money without the penalty until you turn 59 and a half, right? So there's definitely some tactics in there.
Yeah, and that's kind of we've been pretty transparent about that when we've talked about it in the past, but that's similar to the strategy that we did. Yeah. So you leave enough in there that you can have access to it if you need it, but take a certain portion and put it in an IRA so it's easier to manage, not only just for you, but if you hire a financial advisor, they can manage it for you.
Yep. So there are, however, ways to avoid the early withdrawal penalty if you retire prior to the year in which you turn 50 or 55. And that's based on the life expectancy table. So if you're a regular government employee, if you're not one of those special category people, then if you retire, let's say you retire at age 53, if you use the life expectancy table, which is it's equal segments based on the life expectancy table. So you get so much a month based on the that methodology. If you use that, say you retire when you're 53, if you use that until you're 59 and a half, then you can change it at that point and do different kinds of withdrawals. But the only way that you can retire before 55 as a regular government employee and not get the penalty is to use the life expectancy option. And you can also use it in IRAs. So if you retired early, rolled your TSP into an IRA, you could withdraw from an IRA before 59 and a half, but the only way you can do it is if you use the actuary table methodology. So it gets complicated, but I thought it was a pretty interesting article. Okay. Gaps. So the market has been crazy, and one of the things that it's doing a lot of here is called gapping. It either gaps up or gaps down, which basically just means if it's a closing price we're looking at, if the market closes on Wednesday at 54 and opens on Thursday at 55, it just gapped up $1, right? So this is a chart of Meta going back to its IPO there in 2012, and from the very beginning, you can kind of see right there, Meta kind of, once it got its legs about it there, had a big gap up in the beginning, and then it just took off from there. So there's basically three kinds of gaps. There's a breakaway gap, a continuation gap, and an exhaustion gap. Okay, so this is a breakaway gap. It's a great thing to trade. A lot of people say that all gaps get filled. That's a very common kind of meme on in the market, but obviously they don't all get filled, right? So you have a really good base here in Meta, and then it gaps up, and it's the beginning of this huge run. This is also a breakaway gap, but it's to the downside. Okay, so gaps they definitely go in both directions, and they're significant. So usually, if it gaps up or down, it's going to continue in that direction. This was another big one. This is a continuation gap, really, because we already had this big move down to the downside, and then it really gapped down and kept on going. Okay, and then finally, Meta hits, $100, good round number. Gaps up there, gap here, and the monster gap this week. So the question is going to be that you never really know. This is either a continuation gap or an exhaustion gap. An exhaustion gap happens at the very end of something like this big move higher. I would say in this case that usually if it's an exhaustion gap, it happens, and then within a couple of days, it rolls over. So chances are Meta is probably in pretty good shape. And based on Friday's, I think it's up like 2 or 3% today. So I think Meta's still in good shape. But that's the other reason I put this up here. So this is the all-time low in Meta, which is where I drew the Fibonacci tool from there to the peak in 2021. It retraced pretty much to the tick to the 0.786 retracement level. So these Fibonacci levels are really important. It basically gapped right through that 38% retracement level. So while this could be support, this gap down to it is pretty much telling you it's not, right? Then price comes down to the 61.8 level and kind of banged around there for weeks, right? And finally broke below it. So obviously that support level failed. But the next one held. Okay. So Fibonacci levels are pretty good to kind of get your arms around. So if we zoomed in a little bit, what we're looking at is basically this piece here. Just kind of zooming in. you got this big gap, continues down. This is what I mean by exhaustion gap. Okay, it's only a couple days. It's continued lower, but only for a couple days, and then reversed. So this was the exhaustion gap to the downside. This is kind of the breakaway gap to the upside again. This is a continuation gap, and this I would have thought would have been the exhaustion gap at the end, but again, Meta is continuing higher. So, yeah, it's amazing to me that Facebook is still even relevant, much less continuing higher, but it certainly is. All right, so don't let gaps.
Just because you don't like it.
I don't like it, not at all. Don't let gaps scare you off. They're significant, so definitely when you see them, pay attention to it. You don't usually see them in indexes, so you don't usually get them in TSP. All right, Apple. So why would Apple be something that we would want to watch? It was the number one. Now it's down to number two because it hasn't been doing that well this year, but it's the number two biggest stock by market cap in the S&P 500. So it's 6% of the S&P 500. So every $100 that you contribute towards the C fund, you and everybody else, $6 out of that 100 is going to Apple. So it's unbelievable. It's almost free money for those guys. It's not that it's going to Apple, but it's buying shares of Apple stock at the end of the day, right?
Yeah, it's investing in their company for sure.
And this is the other good one. Interesting thing about this, we talk about the Magnificent Seven. Tesla obviously is no longer in it, down to 11. Although Tesla's worth looking at because it's potentially at a support level, but it's no longer in the Magnificent Seven. So Microsoft, Apple, NVIDIA, Amazon, Facebook, Alphabet Class A. Interesting. Usually these are around Alphabet A and B. Are usually pretty similar, but Berkshire Hathaway is always in there too. So Berkshire Hathaway not so much, but all these obviously are big cap tech companies. So Apple being number two. If it rolls over, it's going to have a pretty big effect on the S&P 500. So what does it look like? This is as of Friday at around noon. We're going back to the peak in Apple in the end of 2021. So, along with the rest of the market, Apple corrects in 2022, came up, got above that prior high, right? Didn't last there very long, corrected back down, came back up. So now we got this sort of double top here at Apple. And the question is, which way does it go from here? Apple being the second largest company in the S&P 500, the C fund it just keeps climbing. If Apple rolls over hard from here, it's going to be very tough for the C fund to keep going, unless there's some really significant rotation, which is possible. But if Apple really rolls over, we're in trouble. But the point of this was that's kind of a channel line that I'd be looking at. This was the peak in 2022. It was a gap down there, so it failed as support, came back above it, failed again, finally got back above it. And then we've had for the past, since the beginning of the year, we got 1, 2, 3, 4 touches at 180. And then today we broke through at the bottom of that channel. So Apple is not looking good right now at all. So it's just something to keep in mind as you're watching the C fund go higher and higher. If you start seeing the generals, as they're called, start falling, the C fund's not going to be far behind it. Okay, monthly candle charts. So this is a chart of the S&P 500. We're going back to 1999. And a couple things I just wanted to point out. So each one of these ticks is 1 month of price movement. Okay, so it's from the close on 1 month to the close on the next month. So it's not great for a timing tool, but it definitely shows you the direction of the primary trend. So this was the 2022 decline, right? So it fit exactly within that channel. So all I did was connect the major lows and drew that trend line. And then in TradingView, which is this software, you can clone this line, and it gives you this line, and you just move it up to the top to create that channel. So we had a little bit of an break to the downside of that channel during COVID, and we had a little bit of a break to the upside on the response out of COVID. But for the most part, that channel is holding really well, right? So it would make sense. We don't have to go there in a straight line, but it certainly makes sense that the S&P gets up here and hits that top channel line. Now, every time it's hit that top channel line since 2011, it's rolled over. But it's 5,600, so it's got room to go higher. And then even on the next pullback, the next correction, which who knows how long that'll take or when it happens, it can be a significant on a percentage basis, but it can still remain within that channel. We talk about Lance Roberts quite a bit. He does what's it called now? Thoughtful Money, the weekly update with Adam Taggart on Thoughtful Money. And one of Lance's big kind of observations last year was that this low didn't do anything other than take us back to the bottom of the channel, in the big scheme of things. So while 2022 was, a rough year and everything, it didn't do anything to change the structure of the overall bull market that started back here in 2009. Okay, so and you only really see that looking at monthly candlesticks. Okay, so that's the C fund. S fund, don't worry about this. I don't know why that's there. I can't figure out how to get rid of it. Maybe you can't get rid of it. Maybe there was somebody that actually did a trade up here, which I think is very weird. At any rate, this is the S fund going back again to 1999. And so a couple things to point out. You got this level was resistance, right? We basically had a double top here in 2000 and 2007. Market comes down, comes back up, and it took some work, right? It was resistance for a couple years, and then finally broke out, right? So it breaks out, comes up to the next level, which is resistance, okay? Broke out there. Now it's down here, and it's support at that level. Okay, so if you can identify areas of support and resistance, they're great places that you could buy. So right now, S fund came down right to that support level, came down and retested it last year, and then has broken to the upside. So the S fund on a monthly basis looks really good, and we also have a huge candle right there, a little, this red candle here kind of just took the froth out of the one before it. And then this month, we get a follow through. So the S fund is looking really good on a monthly basis. I fund. I fund looks good, right? The cool thing about this is you got 1, 2, 3, 4 points. And so the I fund can definitely run up there to like 85. I mean, all it has to do is keep the pattern in place. And I don't have any reason to believe that it wouldn't. I mean, huge breakout candle there, and we've had 4 up months in a row. It is unlikely to go up there in a straight line, but it's certainly likely to get there. If the history of the pattern continues to play out. F fund. This is also a good one. We've been talking about this for a long time. This is the peak. 1, 2, 3, 4, 5. And so this overall 1, 2, 3, 4, 5 is going to be a bigger 1, right? Then we should get, it should do like this, an ABC for 2, and then another big move to the downside. So from a candle perspective, that was a monster outside candle, right? It engulfed everything from the previous month, right? So it took out a lot of the gains from the month before that. So this February was a very rough month for the F fund. It would be great to get a couple more down months and then start moving higher to give us a 2 and then the big move down. We're actually watching the F fund really closely because theoretically we have a really strong 5 move down, and so we should be getting this A, B, C for 2, and this should coincide with a collapse in stock price. So if we get there, we'll be talking about it, but that's what we're looking at. All right, C-Fund chart. So this C-Fund chart weekly, this is the top in 2022. I can't remember, we definitely talked about it on the webinar this week, but divergence, right? You got price moving higher, and you got the relative strength declining. And MACD had already turned negative. It's telling you that the market's getting ready to roll over, right? It's a kind of a pre-warning. But you don't get it all the time. On this peak, relative strength peaked, MACD is still positive, and the market goes down. So relative strength is putting in lower highs along with price, which is what you would expect, right? And eventually, MACD does turn negative, but you're not getting an early indicator that the market's getting ready to roll over, right? Price keeps going up, relative strength is going up, price goes down, relative strength goes down. There's no divergence. There's nothing like this. Okay, so you don't always get that. So when we're looking at where we are right now, RSI looks great. There's no divergence there. RSI isn't rolling over as price continues higher, right? MACD is great, expanding to the upside, everything's good. Just because we don't have divergence doesn't mean that price can't roll over. But when we do get it, it's a really good early warning. Okay, so just because we don't have this doesn't mean that it's all clear, because it could just as easily go that way, right? So you have to pay attention. But there's nothing telling us right now that the market's getting ready to roll over. Okay, at least on a weekly basis. Questions? Yeah.
All right.
Sorry.
If you guys have any questions, you can always hit us up in the comment section wherever you found the video. And if there's no comment section, you can shoot us an email at support@growmytsp.com, and the support team will shoot it over to us. We get a lot of feedback, and we love it. So if you guys have any thoughts, criticisms, critiques, anything, man.
It's all good.
You know, it's nice when you give us I like it when people give us their thoughts, you know, about things that we're talking about, and you know, it might be a different viewpoint, but that's cool. And if you like the video, share it with your friends.
Yep,
if you don't like the video, share it with them anyway. Hope
All
you guys have a great week, and hope you're having a great weekend. All right,
out of here.
See ya.